Welcome to today's episode of the Simply Financial podcast. I'm your host, Christopher Calandra. Want to increase your financial IQ with today's episode. Today, I have with me my teammate, associate, and good friend, Brett DiPasquale, part of the excellent team here at Osaic Wealth Management Services. And what we want to do is talk a little bit about some of what we're hearing from clients this year. So, Brett, appreciate you taking a few minutes to sit down with me.
Of course. Thanks for having me.
So we've done, between you, myself, and the rest of the team, we've probably done over, what would you say, over 100 meetings, around 100 meetings so far in the early part of 2025. Does that sound about right?
Yeah, it's been a nice fast start.
So if you're not a client and you're listening to this, we have routine meetings with our clients, communicate with them regularly. And there's been some recurring themes, things that clients are bringing up, questions that they ask us as we discuss the results of 2024 and the outlook for 2025. So, Brett, what would you say is the number one thing we are hearing from clients about?
The biggest thing is, well, first of all, we love delivering good news. And obviously, we've been able to do that since the past 2 years. The stock market has done very, very well, and our clients have done equally as well with some great returns. So I would say the number one thing right now is people questioning what 2025 will look like after a very successful 2024 and previously 2023.
Okay, so it's almost like, and I've been at this a long time, I know you have too, we're very experienced, is they like the good news and they're appreciative and generally are very impressed with how their accounts have done. They're sort of waiting for another shoe to drop, like when does the party end and how bad is it going to be? So there's optimism combined with when is the party going to end?
Yeah, it's kind of a, well, what now? We've had 2 great years. What's this year look like? Will there be a drop, and how are we planning for something?
Okay. And so, how would you describe generally now? Understand if you're listening to this, our clients are very diverse, age-wise, financially, their individual goals. So we're just talking in generalities. The answers for an individual client might be different depending on their personal situation. Generally speaking, though, how do we respond to this thought and maybe concern?
Well, the biggest thing is we're taking a non-emotional stance towards everything. So when we get together and we review our portfolios and our investment committee that we do monthly, we take a look at the actual numbers, the economy, and really try to stay unemotional, because a lot of where our clients' questions are coming from an emotional way of looking at things, which there's nothing wrong with that. Um, but at the same time, you have to look at what the portfolios are made up of, diversified correctly, and making sure that the fundamentals of them are solid given what's going on in the economy.
And can you share with listeners generically? We have taken some steps, not based on feedback from clients, but based on our own analysis, leaning into our own experience unemotionally, looking at the data. We haven't taken some steps for many, many clients to adjust to what we think might unfold in 2025. Can you touch on that again, very generically, not any explicit advice for anybody listening, but just a generic overview?
Yeah, I mean, we've just taken a posture of making sure we're very diversified, and at the same time taking a little bit of a defensive stance as well. So we remain optimistic. We just think that we aren't as optimistic as the whole market. So that being said, we just took some risk off the table in some of the positions in our portfolios. Everyone out there has probably heard of the Magnificent Seven inside of the S&P 500. So Apple, Google, Nvidia, Tesla, and so on. They've driven so much of the gains in the market in the past couple years that we decided to trim those positions a little bit and go to a diverse and defensive stance, but still giving clients the ability to have great returns if the market has another fantastic year in 2025.
Yeah, exactly. We took we reduced some positions that had done exceedingly well, like you talked about, ones that have significant allocations to the Mag 7 and companies like that, sort of like sell high kind of thing. And we added to the diversification of portfolios, deploying some money in some areas we think are attractively priced. So even though we're optimistic about this year and don't think another shoe is necessarily going to drop, we do recognize after 2 good years, the market's done very, very well. The US stock market is expensive by many metrics that we follow. And these are not like unique to us. These are mainstream kind of metrics that most financial and investors will follow. The market's expensive. So we wanted to add to the diversity in the portfolio and be a little more defensive. And we like how we're set up for this year. So that's the key thing that folks are mentioning to us as they discuss their goals for 2025 and beyond with us. What else would you say is a key topic of discussion?
Well, I think too, kind of just finishing off the first topic is it's really defining expectations and defining what success really is. I mean, as you know, a lot of our clients are financial planning clients, retirement income planning clients. So how we're basing success is based off of getting good returns that fit into one's plan. So these outlier years that we've just had help us out a lot, but at the same time, it's kind of just tampering what a good year is.
That's right. Yeah. No, that makes sense. Do you I think the second most in my mind, I think you would agree, is the idea of what the Trump administration might do with tariffs. That is something we're getting a lot of commentary about, and I think that's fueled in large part by what they might be hearing from the media. So how are we tackling that thought?
We're telling clients that it's really a waiting game. So our belief is that the Trump administration is using tariffs as a negotiation technique. So we don't necessarily know what will happen, how it will happen, and how the world will react. But at the same time, we're trying to stay still pretty unemotional about it and let the markets do what they have historically done. So we think it's a negotiating technique, and overall, we think it will be beneficial.
I think that's good, and I'm glad you revisited the emotional part, because when the Trump administration or even President Trump himself announces these tariffs, or even in his own special communication way, sort of mentions something in passing that's sort of like dropping a hand grenade into discussions. There's some people that can freak out, act emotionally, and react very strongly to it, which is not something that I would criticize, except caution that if that spills into making investment decisions, that is not a recipe for success in all likelihood. So we're taking a wait and see approach. If you listen to our economic updates, we've talked a lot and consistently that there'll be tariffs, but we have to wait and see how it goes. And at least in part, what the Trump administration is going to do is to use the threat of tariffs as a bargaining chip, part of the negotiations where the United States wants to rework one or more deals with countries around the world, and the EU as another example, the European Union. And I think this, at least as of this recording and in the early part of 2025, has been an accurate portrayal of things for us. We've given good advice because the markets have not reacted negatively to any of the talk or announced tariffs that the Trump administration has done. So we have our opinion, but so far our opinion has been shared by the market. You haven't seen, Brett, where Trump announces something and it might be something expected or maybe something wholly unexpected, and the market really reacts terribly to it. I could think of one day when the market had a pretty good down day because of something related to tariffs, but then it rebounded the next day. So we just want people to wait and see, allow it to unfold. We have 4 years of this administration. They have a pretty aggressive agenda, reacting emotionally to every single thing that is announced and transferring that to investment decisions is not what we are going to do. And we think that that's a good recipe for success, is just to let it play out. I give a good summary of that.
Yeah, definitely. And I think it's important to point out too. I mean, we're only sitting about 14 points below the all-time high of the S&P 500. So with all this change in the US over the past month since the beginning of the year, the markets continued to thrive.
Yeah, agreed. All right. So we talked about how clients are wondering how long this good period of market performance will last. Is there another shoe to drop? We're getting discussions about tariffs, and in some cases, especially people that tend not to have voted for Donald Trump to be president again, they tend to be kind of fearful about the tariffs, and we're given what we believe is good advice. What other topics you think are worth mentioning in this podcast?
I mean, I think the other one would be interest rates and how they've began to fall in the fourth quarter of last year. And now we have the Fed signaling that they're going to keep them higher for longer. So that's been a pretty big discussion item in the sense of, number one, interest rates have remained high, but still came down a little bit, especially in savings accounts, CD rates. And it also kind of goes into the real estate market too, with clients looking to potentially buy a house, refinance a house, um, remove some debt that they have. So interest rates are a big one.
Yeah, and it's been an environment the last stretch where the Fed has been as central to what's happening in the market as they ever are. You know, we had them raising rates aggressively to bring down inflation. And then when they thought they had wrestled inflation under control, they began cutting interest rates. But they didn't cut his interest rates in 2024 as much as expected in early 2024. And the expectations for 2025 have changed. There used to be a consensus that we'd have lots of interest rate cuts in 2025. That's changed. So it's been a very fluid environment over the last stretch in terms of Fed policy. As we already talked about, the market has reacted favorably to this somewhat uncertainty about the Fed's direction and some of the changes in Fed expected policy changes. And I think you and I are in agreement, Brett. I would be in the camp that says the Fed would raise interest rates, reduce interest rates only one time in 2025. That would be my forecast for this year. Is yours the same or different?
Yeah, I think it's going to be one time this year, unless there are some outside pressures that maybe lead to an additional one.
And I'll add that I think my bias would be to no interest rate cuts. If you miss on the one, I think it's more likely to be zero than two or three. Is that your take too?
Yeah, I would agree. I would definitely agree with that. Two to three would be a high number.
Yeah, and I think part of it is inflation is not nearly as big an issue as it was previously, but it has been stubborn. It has been stubborn, and the trend line was coming down fast, where inflation was coming down with regularity when the Federal Reserve was raising interest rates and doing their thing to get it under control. But now it's kind of been stubbornly high. It's not, again, as problematic as it was in 2021 and 2022. But it's still not where the Federal Reserve wants to be. So that's something we want to watch. And clients are aware of this because of car loans, mortgage rates, and also a recognition by them that interest rates do play a role in the economy and how the markets might behave. So I think those are three key things that we're talking to clients about. And we will do some economic updates mid-year. We'll continue to communicate you, our listeners, and our clients on a regular basis with weekly Simply Financial podcast shows. So if you want further information about the work we're doing, how it might affect you, go to the website, elliottwealth.com. You could sign up for a complimentary consultation. If you're listening to this and you're a client, just call or email us and we will respond promptly. Thanks for listening, everyone, to today's episode. Brett, thank you for your partnership. And I'll be back with you on the next episode of the Simply Financial podcast very soon. Have a great day.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.